Guys, I've got to be really honest with you in this video. For years, I've just totally ignored Melbourne property. It just hasn't stacked up. And whilst Perth and Brisbane were booming, Adelaide was quietly outperforming. I mean, even Sydney had its moments. Melbourne, well, Melbourne just lagged. And it wasn't just COVID lockdowns. No, it wasn't people leaving the state. It was much broader than that. The state government hasn't exactly helped investment confidence either. Higher land taxes, constant rule changes, and just a broad reputation for being anti-investment. A lot of people, they just threw their hands up in the air and said, well, why would I bother with Melbourne? But here's the thing. When a city with Melbourne's fundamentals, its scale, its jobs, its universities, its sport, its restaurants, its culture, its hospitality, when it has all of these things and yet it underperforms for this long, it doesn't stay down forever. Recently, I've been digging into the latest data, and for the first time in a long time, I think Melbourne is actually showing signs of turning the corner. So today, I wanted to walk you through why that might be happening, what the next 12 months are likely to look like, and if you stay right till the very end, I'm also going to touch on where the opportunities might be hiding and how you can position yourself best to capitalize on them. Guys, my name's Josh. I'm from Data Edge Property. I help everyday Australians grow their wealth in Australian property using data that's accessible to absolutely everyone. So with that being said, let's jump straight into the video. So I wanted to touch on Melbourne's recent track record. So you look at the last 4 or 5 years and you've had COVID lockdowns. They spanned all the way from 2020 into 2022. And believe me, it cut deep. Being a Melburnian, I felt it. On top of that, you also had migration losses where we lost a ton of people to Queensland, to New South Wales. They just didn't want to be here. On top of that, we had weak investor demand. The government had a bunch of policy uncertainty, the introduction of higher land taxes, more onerous requirements for landlords. You know, I've got an investment property here in Melbourne and you've got to complete annual gas and electrical safety checks and whatever you might think of those policies. Personally, you know, I think it's a good idea. I think that properties should be brought up to standard. Nevertheless, if you're a long-term holder in Melbourne and all of a sudden they're bringing in these changes whilst you're not used to them, a lot of that can dampen investor sentiment, especially when those same things haven't necessarily been brought into the other states. Nevertheless, if we look at the most recent data out from Catality, and I'll bring up this chart here, we can see that as of August 2025, Melbourne's dwelling values, they've taken a turn. For the month, they're up 0.3%. For the last quarter, they're up 1%, and they're up 1.4% annually. And whilst these aren't going to blow anyone away, certainly not when you compare that with Perth and Brisbane, which are both growing at, 7, 8% annually, it's taken a turn, especially after years of sideways movement or in some cases even decline. But I wanted to touch on a different matter, and that's the long-term growth story as well as this concept known as mean reversion. Over the past 30 years, Melbourne, it has averaged 6 to 7% growth on average. But since 2017, Melbourne's badly underperformed that average. Prices really across the board are only up 15 to 20%. And on a per annum basis, you can tell that that's quite a bit lower than that average. Whilst the other mid-tier capitals, Brisbane, Adelaide, Perth, they've surged as high as 70% since COVID came on. And if you have a look at this chart, it actually shows you the median home prices in Adelaide and Brisbane and their relative values compared to Melbourne. So probably the biggest outlier of them all is Sydney, where you can see on this chart here that in 2011, Sydney prices were only 10 or so percent higher than Melbourne's, whereas we are now sitting in 2025 and they are over 40% higher than Melbourne's prices. So if we're just looking at mean reversion, one of two things need to happen. Either Sydney prices need to fall, which, I mean, that's an entirely different video, or Melbourne's prices need to rise from where they are. And if we look at Brisbane and Adelaide and Perth, the median values are pretty much in line with where Melbourne is now. And if, again, you look at historical averages, somewhere like Perth was used to being 20% lower than Melbourne. So we're clearly out of whack now. And that divergence, it's an outlier. Historically, Melbourne doesn't stay behind for long. It reverts to the mean, catching up after a period of lag. And the gap that's opened up, especially looking at that chart, it's glaring glaringly obvious. And the ingredients for a rebound, affordability versus Sydney, migration, and tightening rentals, they're also beginning to line up. So there's definitely signs of a shift emerging. And the first thing I wanted to touch on was auction clearance rates. We're now sitting at 68% for Melbourne. And although that's not, your boom time auction clearance rates of 80+%, it's still a move in the right direction. And when you look at it in the context of demand and supply, which I'll touch on in a moment, it paints an even clearer picture. I'll bring up this chart from Cotality as well, which charts sales volumes, in particular across the last 12 months to August 2025. And it shows that for Melbourne, sales volumes are actually 8% higher. And you can use sales volumes as a proxy for demand. And when you see that and you compare that to the other capital cities like Perth, Adelaide, Brisbane, Sydney, where you can see sales volumes are actually decreasing, you can see that on the ground, the market dynamics are shifting and buyers are definitely showing up to purchase property in a bigger way than they were historically. Now, when you combine that with the listing story, which you can see in this second chart that I've brought up, listings for Melbourne are 15% lower than they were equivalent period last year. On top of that, they're 4% below the 5-year average. So when you combine those two factors where demand is clearly higher, and you can see that through the higher sales volumes, whilst listings are down, that's definitely a sign of a market where demand and supply are beginning to constrain. And the more that that ratio gets hotter, the more that you have an imbalance between demand and supply, the further price pressure you have on prices to go up. But why do I think now could be the time for Melbourne? It's more than just supply and demand dynamics, and it's more than just auction clearance rate. There's other factors. Population growth, it's a big one. Victoria is growing at 1.93% annually. Not the fastest rate of growth. WA is in the lead. It's at 2.39%, which you can see from this chart out of the most recent State of States report. But Melbourne is adding the most in raw numbers because whilst the percentage is lower, given the population of Victoria is higher, a slightly smaller percentage on a much bigger value means there's much more people moving to Victoria. And that's going to put additional pressure on the demand side of the equation. Now, it's not just population. You've also got the rental market. And although rents are up only 1.2% year on year, which is not a great deal, vacancies are compressing. So if you have a look at this chart from SQM Research, you can see that the vacancy rate now is just over 1%. And if you don't know much about vacancy rates, all you need to know is anything under 2%, and that's a pretty tight market. When you get close towards 1%, that is a super tight market. And some markets in Australia, like in Perth, you have certain suburbs where vacancy rates are below 1%. And that's just like rental properties are moving like hotcakes. But the fact that vacancy rates are continuing to compress, that's going to put added pressure on the rental market. I would expect for rental yields to continue to increase, certainly across the medium term. Why else do I think that? Importantly, bond lodgements are falling. So I'll bring up this chart that shows the active rental bonds in Victoria. And you can see that since 2023, the figure of rental bonds in Victoria is dropping, and it's dropping steeply. And what does that mean? That means that investors are taking their properties off the market. Guys, it's simple supply and demand dynamics. If you take investment stock off the market, there's less rentals available. And what's that going to do to prices? If there's even more people coming into the state, it's going to put pressure on rental growth. So I would expect in the medium term, yields will improve, and that's going to invite investors back into the market. Now, you layer on top of that the credit environment. We know that interest rates currently sit at 3.6% in terms of the RBA cash rate. Mortgage rates are about 50 basis points lower than they were in January. Melbourne is historically a rate sensitive market because the median values are always tend to be higher than the other capital cities. It's an expensive market. And if we look at history and what's happened before, after the RBA's 2019-2020 rate cuts, Melbourne surged 12% in a year. Conversely, during the 2022 and 2023 rate hikes, it fell harder than most, down 7 to 8%. If you have a look at this chart in the AFR, it was presented by a Bank of Queensland chief economist. It actually charts the change in house prices in the 2 years after the start of a rate cutting cycle. And you can see that the worst case scenario, and that was during a recessionary time, prices still went up by 5%. But you look at most of the other periods and And you can see that prices grew at least by 6%. In some periods, 11%, 15%, 32%, in 2010 by 15%, or in 2021 by 27%. Although this is a national story, this was definitely felt disproportionately in Melbourne, where leverage and sensitivity means that this easing cycle could matter even more for Melbourne than almost anywhere else. And all of these factors are going to play into the sentiment on the ground. You're going to have more bidders in the room. You're going to have stronger opens for inspection. You're going to have investors slowly circling back into the market. So there's a lot of factors there where in isolation, they might not be groundbreaking. But when you look at them together, you can see that Melbourne is certainly past its worst. And if anything, it's on the path to recovery. So your natural question might be, well, where are the pockets of opportunity? And the answer to that question are varied. There's a few. So you've got the inner and middle ring family suburbs, areas like Beenleigh East, like Preston, like Reservoir. You're going to see strong demand in those areas from upgraders. You've got other areas like the mid and upper quartile suburbs, areas like Camberwell, Glen Iris, Kew, the more affluent areas of Melbourne. These areas are still 5 to 10% below their 22 peaks, yet they have strong fundamentals. You've also got the lifestyle precincts. This is the beautiful thing about Melbourne. You've got so many diverse areas where you can make an entry into. Areas like Bayside, where you've got Sandringham, you've got Hampton, you've got Bay Morris, you've got Hyatt, you've got Seaford, you've got Aspendale. These areas will see lifestyle buyers returning as affordability improves compared to areas like Sydney. And you've also got the western gentrification corridors, areas like Footscray or Sunshine, where you've got major infrastructure projects, but also you've got major changes to the demographics in the area. But it isn't just the area that's important. As successful property investors, we know that the asset type is equally important. And historically, houses outperform any other asset type. They do better than apartments, they do better than units, they do better. But in Melbourne, well-located townhouses, in particular duplexes, they can strike a great balance. They generally offer higher yields than detached houses, but still underpinned by land content, which means you benefit from land appreciation as well. Now, this is especially important for Melbourne compared to when you're investing in the other capital cities, because at least historically, Perth, Brisbane, and regional areas, they offer attractive yields on houses. Melbourne doesn't, at least not in all areas. So sometimes you've got to be selective with your asset type. And whilst we're on the topic of asset selection, if you're not sure how to assess whether a suburb or a particular property is investment grade, I've actually put together a completely free asset due diligence checklist. It's something I review every single time I am reviewing a property. It covers over 40 major factors that can impact a property's value. If you're interested, I've got it in the link description down below. Again, it's completely free. With that being said, let's jump into the fringe entry markets. And these are the areas where I'd be a little bit more cautious with. So you'll hear a lot of talk about the entry level suburbs, places like Broadmeadows, Dallas, Meadow Heights, etc. I'm sure you've heard of them on other podcasts. And you've heard of them because a lot of investors are piling in there at the moment, because the demand to supply dynamics in those areas look appealing right now. And although I don't think those individuals are going to miss out on long-term growth, I genuinely believe those areas will do well. They'll do well just as well as any other area, certainly across the very long term. You know, as Melbourne expands outwards, these areas will generally do fine. But, and this is the big but, what you've got to be prepared for is the tenant side of the equation. No one talks about this. These areas can come with more headaches. Oftentimes they have a higher crime rate. You're going to get, as a result, higher turnover, more arrears risk, and more wear and tear. You've got higher unemployment rates in these areas. Now, if you're hands-on and you're ready for that, that's fine. But again, you just got to be aware of these things before entering into an area. I'm not saying go into this area or don't go into this area. Just make make sure you're aware of these risks before you make the plunge. Now, if you'd like me to do a proper Melbourne deep dive suburb analysis, breaking down which areas I'd be leaning to and which areas I'd stay completely clear of, leave a comment in the section down below and tell me what you want to see in that video specifically, and I might have something out soon. So that's a good segue into my 12-month outlook scenarios for Melbourne. And like always, I've got a base case, I've got a downside case, and I've got a absolute best case upside scenario. So starting with the base case, I'm saying in the most likely set of scenarios, I'm going to say 3 to 5% growth. Some will say that's conservative, but I think you can't just look at those high growth areas that everyone's talking about right now. You got to look at Melbourne as a whole, and there's still things that are going to hold it back. What are the assumptions behind my base case? Well, it assumes that the RBA interest rate stays either steady at 3.6 or perhaps we see one more rate drop from here on in. It also assumes that listings rise modestly from here, but they stay below average, which is where we are right now. It assumes migration remains at the current rate, which is what we mentioned earlier, at the second fastest pace, but the fastest in absolute terms. And lastly, it assumes that Melbourne tracks to its historical track record of being sensitive to interest rate cuts, which I fully expect will be the case. Now, in my upside scenario, I'm saying 6 to 8%, and I think that'll be a pretty strong result for Melbourne. I hear predictions out there of over 10%. I'm just not seeing it. It will happen in certain areas. I can absolutely see it happening in certain suburbs, particularly the lower entry-level areas. You will get probably even quicker than 10%, but a median as a whole for Melbourne, I'm just not saying quicker than 8% in 2026. It's just too early in the cycle. Now, what would need to happen for that 6 to 8% scenario to unfold? Would need listings to remain scarce, drop to say between 15 to 20% below their 5-year average. Investors would need to return to the market, chasing relative values versus Sydney. And what that would require is the state government to just relax a little bit. And I say that as nicely as I can as a Melburnian. The government's already implemented a lot of change. I'm not saying they've got to wind back land tax or wind back the changes they've made, but they need to slow down the scale of these changes. Thirdly, rental growth would need to accelerate from here and accelerate from about 1% to say 3 to 5%, which could happen. I don't think it'll accelerate that quickly because inflation is slowing, but nevertheless, that's what my scenario assumes would occur. And lastly, unemployment would need to hold where it is right now. So that if those things were to take place, I think the upside scenario of 6 to 8% is very achievable. Now, my downside case, and I'll do this one quickly because I don't think it's likely, particularly from the data that I'm seeing right now. 0 to 2%, I'm saying, again, I don't even believe the downside case, but if the following happens, so the job market would need to weaken, would need to see unemployment rise in a material way from where it is now, would need to see a spring listing surge, so a bunch of stock would need to enter the market and would need to be above our 5-year high, which we're not currently at. Investor demand would just need to remain completely muted, which again, I'm not seeing right now. In fact, I'm seeing the opposite where sentiment appears to be improving. And then all of that would need to absolutely blunt the interest rate cuts and potentially no further interest rate cuts, stuck at 3.6%. So that was the last factor. Again, I don't see this as a particularly likely scenario. Now, the second last thing that I wanted to touch on was who Melbourne's actually suited for. What type of investor would Melbourne be suited to? And I'll start who the best fit is for. What type of investor? So you need to have a long-term investor outlook. You can't be going into Melbourne expecting quick growth. You need to have the mindset that it's going to take at least 5 to 10 years for a full cycle to come through. And anyone that's promising you, especially a buyer's agent, that you're going to get into Melbourne and get immediate growth, other than some select areas, I'm just not seeing that at the moment. So you got to have a long-term mindset. Secondly, it's for upgraders and families who are seeking relative affordability, in particular from interstate areas like in Sydney. I've had friends come here from Sydney and the first thing they say to me is, Josh, the property prices in Melbourne are so bloody affordable. So again, that type of individual doesn't need to be an investor, even just families who might be looking to relocate. Melbourne is a fantastic fit. The number of amenities and benefits that Melbourne has and the affordability that we're currently seeing seeing, it's unprecedented. It's something that a lot of individuals will take advantage of. Now, the last type of investor that Melbourne is best suited to are contrarians, those who like to move before the narrative turns. So no one is speaking about Melbourne now, with the exception of some select few, as I said, entry-level suburbs. Absolutely no one is speaking about Melbourne. So if you want to get into a market early before it has started to jump, because nothing is harder than buying a property once the market is already moving. We've learned that in Brisbane, we've now learned that in Perth, but Melbourne has not taken off yet other than some select areas. So who shouldn't invest in Melbourne? Well, it's yield hunters. So if you're very yield sensitive and you need good cash flow, well, Melbourne's probably not the market for you. You're better off looking in other parts of the nation where you can still get 5, 6, or even 7% yields in some instances. You're just not going to get that in Melbourne. It's a capital growth play. Secondly, short-term flippers. Again, it's not a market where we're seeing rapid growth other than select few areas. So if you're looking for a short-term flip, a renovation, and then just to sell a property, you're not going to make a huge amount of money in Melbourne right now. Lastly, if you're a highly leveraged buyer, again, I wouldn't be investing in a market that is cool / only just beginning to heat up. It's just too risky right now. So what strategy would I be employing if I was an investor in Melbourne today? Well, there's probably 3 key ones. Firstly, I'd look for value add plays. Places where you have subdivision potential, renovation potential, development potential, and it might be not right now. It might be in the future. Perhaps you can add a granny flat at the back, but it's something that I would prioritize whilst you can get into the Melbourne market without much competition there, and you can get these types of assets for a good price. Secondly, I'd prioritize suburbs where there are tight rental conditions. Look at things like vacancy rate, like stock on market, like the rental yields in an area, the renter proportions. The last thing you want to be doing is entering into a suburb at this point in the cycle and there's 50% rental stock in that market. You're setting yourself up to fail. And lastly, again, I would consider well-located townhouses with high land content. They offer stronger yields than houses with solid long-run capital growth. You might get slightly weaker capital growth, but at least the strong yield will help you stay in that market for longer and improve your cash flow situation. So guys, with that being said, Melbourne has certainly been an underperformer for years, but it's not going to stay like that forever. With migration back, credit easing, and sentiment improving, mean reversion is certainly beginning to play out. And the data is certainly beginning to shape up and say that Melbourne could be the city that's next to catch up in this cycle. For the right type of buyer, long-term focused, growth focused, not yield sensitive, this could be your time. Guys, if you found this video useful, I'd appreciate if you left a like on the video. Please subscribe. And again, don't forget, completely free asset due diligence checklist. Check it out in the description if you're interested. Other than that, I'll see you in the next video.